I'm Anthony Valeri, Director of Investment Management at Zion's Wealth. Thank you for joining us on the webinar. Today, we will review the third quarter and a preview for the fourth quarter. We'll cover the economy and financial markets with time at the end for Q&A. Let's go ahead and get started, and we'll begin by looking at the economic data, first and foremost, the labor market. And we're in a situation currently where there is limited hiring, but no firing. In the left-hand side of the slide, you'll see that monthly not payrolls have been steadily declining through 2025, where there is very limited job growth, according to this indicator, and other measures we've tracked also show the same, that there is limited hiring. Conversely, on the right, we see weekless jobless claims, one of the better leading indicators of the labor market and the economy, and weekly jobless claims remain very near a historical low. There have been some occasional spikes over the past couple of years, but nothing that goes beyond 260,000. And as the most recent reading, still hovering in the low 200,000s, which again, near a historical low. That tells us that there is limited hiring, but no firing in the economy. And as long as that is the case, we think the economy continues to expand without a recession. Another way to look at this data is to look at the job openings data released from the Treasury Department, which we are still getting despite the shutdown. And job openings have decreased to the point where they now match the number of unemployed people looking for work. And this was one of the Fed's goals, was to lower that opening rate to avoid an overheated labor market and therefore inflationary pressures. And this has sort of reduced pressure on the Fed, and that's why they are turning to interest rate cuts again. But the labor market holding steady. Of course, a big part of that is immigration. The lack of immigration has held down job growth as well. But the key is that there are no firings in the economy, or very limited firings in the economy. Perhaps the biggest driver of the economy is still strong consumer spending. Earlier in 2025, the consumer did slow down their spending ever so slightly. But here in the third quarter, the consumer spending reaccelerated and has increased higher. Here we show overall retail sales in the dark blue line, and then the control group, which factors into the GDP calculation. Both metrics are above 5% and indicate very healthy consumer spending in the economy. And that has been a key driver of economic growth in the second quarter, and likely to be in the third quarter as well when we get that number later this month or in early November. And it's important to realize, that consumer expenditures make up about 68% of GDP. So the consumer is still a workhorse for the economy. If there's any blight on this data, is that there are signs that the lower income part of the consumer spectrum is struggling. And again, credit card spend would tend to corroborate that. So something to watch going forward. But again, consumer spending continues to be strong. When we look at GDP growth overall, it's important to note that AI spending has become a bigger part of economic growth. You'll see on this chart the first quarter of 2025 and the second quarter of 2025 have seen an increase in the gray bar, which is investments in software and information processing. So without that metric, GDP growth would have been a negative almost 2% decline in the first quarter. And in the second quarter, that 3.8% growth rate would have actually been 3% had it not been for the impact of software and information processing. So AI becoming a bigger part of GDP growth and certainly driving it forward. It's an important trend to watch. In terms of the third quarter, economists' estimates have come up because of that stronger economic or consumer spending, rather. The Atlanta Fed GDP now, which tracks the pace of economic growth, is showing a 3.7% growth rate for the third quarter. That's better than expected. It's still early. We have more data to receive, but the economy continued to doing a little better than expected and not showing any impact from tariffs. In response, we're seeing higher growth estimates for not just the third quarter, but also the full year of 2025. The light blue bars show the projection going forward, 1.5 or 1.2 to about 2% GDP growth. We think that is still supportive of the stock market, and we'll continue to monitor those expectations. But again, AI a key driver in providing resilience to the economy. We do not see a recession on the horizon. The inflation story has certainly improved from 2022. You see the peak there and the decline in overall CPI and core CPI excluding shelter. The last few months have been a little stubborn, though, with CPI creeping higher. There's been a modest impact from tariffs, but it's been just that modest. We have not seen a notable increase from tariffs. A big part of that is the green line, which is shelter or housing related CPI, which continues to decline. And it's important to understand on the inflation front that there are a number of factors, including housing, that are pushing down on inflation. So the services component, housing, all pressing down on inflation while there are good prices moving up from tariffs. Overall, we see inflation moving sideways. We don't see a reacceleration low enough to allow for additional Fed rate increases, or pardon me, Fed rate decreases over the remainder of the year and into 2026. So the inflation picture improving, even if much more gradually than in the last couple of years. Let's turn to performance and the third quarter of 2025, a good quarter for investors. Small caps led the way. We'll talk more about some of the nuances in that sector in a moment. Emerging market stocks also up over 10%. And then in light blue, you'll see the U.S. large caps, very strong quarter, up over 8%. That's the S&P 500. Mid caps up just over 5. The large cap equal weight, which is the green bar, was up 4.8%. That's a big difference from the market cap weighted large cap, which indicates that concentration or the largest names like Nvidia, Microsoft, and Apple really moved the market in the third quarter. But it's that concentration theme that has come back and played a role in investment performance. But as you move across to the right, you'll notice municipal bonds rebounded after a tough start to the year, up 3%. High quality bonds on the far right, up 2%. So a good quarter. And on a year-to-date basis, sort of a similar trend here. International still leading, even though the gap closed a little bit in the third quarter. Very strong year for international, first time in a while where they've outperformed U.S. Equities. U.S. large cap having a great year. Again, you see the gap between the light blue and the green, which is the equal weight, which tells you that concentration, after being a detractor in the first quarter, has once again contributed to performance over the last 2 quarters. U.S. mid and small caps having a good year, up over 10%, but still lagging their large cap counterparts. And then you'll note fourth from the right, high quality bonds up 6.1%. For those that predicted the demise of the 60-40 portfolio, that did not materialize, and that diversified portfolio is alive and well and contributing to investor success. And on the far right, municipal bonds, tough start to the year, but they're clawing back now in positive territory thanks to a strong December. So good year for investors thus far, with concentration being a factor in performance. And you'll see that in communication services and technology, after lagging through the first 3 months of this year, have come roaring back. Communication services includes Google, Meta, or Facebook, and also Netflix. So it's those big mega cap tech companies that continue to drive or have driven performance more recently. You'll see at the bottom of this list that consumer discretionary, near the bottom, consumer discretionary is still positive, but lagging the broader market. So if there is a blemish on this equity market and something to watch, it's that these consumer discretionary items, or consumer discretionary sector, has lagged slightly, and that could be a concern. We would like to see that sector reassert its dominance in the market. The other sectors that have lagged, more defensive in nature: healthcare, energy, and consumer staples. So certainly a risk-on tone from the market, and it's always important to note the vote of the market. And we, of course, advocate for a diversified approach, never overloading more than plus or minus 5% in any one sector, given that changes can come without notice. But just to understand some of the drivers within the U.S. equity market. Let's transition to the government shutdown. Lots of questions on this. Historically, government shutdowns have had a very limited impact or no impact on the stock market. Here we show the government shutdowns going all the way back to 1990. There haven't been a lot, but there's still been 6, with the current episode being a 7th. You'll see the number of days the shutdown lasted, the performance of the S&P 500 1 month prior to the shutdown, during, and then 1 month after, and 3 months after. And you'll see that on average, performance is very much positive for all the periods and actually good. So it basically tells you that the shutdown hasn't had an impact. Investors often look through the negotiations and arguing to focus on the fundamentals of individual equities. So no impact for on the equity market from shutdowns. Similar type of no impact on the bond market as well. It's not to say that government shutdowns don't detract from economic growth. They do. They do trend to drag the longer it goes on, with estimates ranging from about a tenth to 0.2% reduction in GDP for every week that it goes on. But often investors look through that and the bounce back for when the government reopens. All right, following a strong quarter, stocks are back to an expensive valuation. This is the S&P 500 in the light blue line, 23 times on a forward PE ratio. That's very expensive outside of the recent range, where PEs bounce back following COVID, which is normal. The market anticipates a profit rebound. You have to go back to 2000 to see similar valuations. Of course, they were higher in 2000. So the market back to an expensive valuation. Valuation's not a timing tool. Over the long term, they influence the degree of performance, and these expensive valuations would indicate a lower return for the S&P 500 after what's been a very strong 10-year period. Also of note, international equities much more attractively valued even after their recent gains. So we maintain an allocation to international while still favoring the U.S., but important diversifier in equity portfolios. If the U.S. dollar were to continue to deteriorate, we don't expect that over the near term, but if it becomes a longer term trend, having that diversification in international equities will be very important. On a long-term basis, the U.S. dollar is still on the expensive side of valuations as measured by the real trade-weighted dollar. So although down about 9-10% year to date, and there's a lot of negative or a lot of pessimism around the U.S. dollar, which should provide some near-term support from a contrarian perspective. It's important to realize the U.S. dollar is still expensive on a historical basis. So something to keep in mind and why you should remain diversified. So speaking of these valuations, are we in a stock market bubble? Common question. News searches are searching on the term bubble, which indicates that on a contrarian basis, we probably are not in a bubble, but just some metrics to show and compare the market today versus the telecom and tech and telecom crash of 2000. So if we look at the cumulative return of the Nasdaq index for the 5 years ending March 3, 2000, which was the peak back in 2000, and then the 5 years ending September of 2025, you'll see that we're not even on the same page. In 2000, the Nasdaq had increased a cumulative 500%. In 2025, the 5-year trailing cumulative is just over 100%. Still a strong return, but again, not anywhere close in terms of magnitude. What about some of the other metrics? Well, let's look at investor sentiment, because when euphoria abounds, that can be set the mark up or make the market ripe for a sell-off. As of the most recent readings, this is the American Association of Individual Investors bull bear spread, and they basically go out every week and survey investors: are you bullish or bearish? And this is a contrarian indicator. The more bullish investors are, perhaps the more euphoria and therefore potential reversal in the stock market. Conversely, the more bearish investors are, has often been a good time to invest. And you'll see that relative to 2000, the sentiment in the market is much more subdued. There is still a healthy dose of pessimism regarding stocks. And as long as that's the case, that doesn't suggest that there is an overly euphoric environment or sentiment behind the stock market. Very different from 2000. And if you look at consumer sentiment, not the investor side, but consumer sentiment, still very negative. This is the University of Michigan Consumer Sentiment Index. Again, much lower relative to 2000. And you could also add inflation expectations, which are still high among consumers. That also runs counter to the sort of ebullient sentiment you'd see around a bubble, and therefore, again, argues counter to that bubble. Large speculators are net short stocks. And what that basically tells you is that there isn't excessive positioning betting on higher profits. These are future or net non-commercial futures positioning, and it shows that large investors are still short the equity market, meaning they're hedging it, expecting it to go down. This is not a case where investors are long or in the market, which would set it up potentially for a reversal. So when we look at the broad subset of positioning, most investors are relatively neutral on stocks in terms of positioning, maybe slightly positive outside of this data here. But again, when you have this sort of short base, it's not the type of market you'd see due for a sharp reversal. Now, there are segments of the market that are perhaps a little more speculative, and we'll talk about that in a moment. But the other part that is defensive in nature, wide profit margins provide a cushion. The equity market, in terms of profit margins, is much more profitable now than in 2000. Again, provides a cushion and makes a strong case for continuing to invest in equities. The market's certainly due for a pullback. Wouldn't be surprised to see a correction. But again, on terms of the bubble front, just not seeing the confluence of data that would suggest that. I mentioned speculative areas in the market, and we certainly have a couple. One of those is high quality stocks have lagged in 2025. This is high quality versus low quality stocks using a 3-year annualized return disparity. When the line goes down, that means low quality stocks are outperforming. And by low quality, we mean those that have not earning a profit, and simply those stocks that are benefiting on the hope of future profitability. We like quality stocks that have a demonstrated track record of profitability, management companies that remained in case and are generating healthy free cash flow. And you can see on this chart that quality being out of favor is becoming an extreme on a 3-year basis. We're seeing this both in large cap and small cap stocks. In the large cap space, momentum stocks have outperformed, whereas quality has lagged notably. And again, a similar phenomenon to what you're seeing here. And it's most pronounced in the small cap space, where we can compare the Russell 2000 index versus the S&P 500, or the S&P rather, small cap index. The S&P index filters for profitability, and that you get a higher quality index because of that. There are no non-earners in that index, and you can see a rising line means that low quality is outperforming. And a couple of things to notice on this chart too is that this is a sharp outperformance of low quality stocks within the small cap space. You'll also notice that this line generally trends lower, which means that high quality stocks over time outperform. So a bit of an anomaly in the market that the low quality stocks are outperforming, especially in small caps. This is one reason why many investment vehicles haven't matched the index in terms of performance, because those non-earning companies have really driven performance. This is not a trend we intend to chase. Stay diversified and stay invested in high quality stocks, which often come via an actively managed vehicle. And one area that is seeing some speculative fever is gold. Gold is certainly overbought. Here is the price of gold relative to its 200-day moving average. This is an extended gap over its moving average, which suggests that gold is due for a pause or consolidation. The reason for gold's increase, central banks are certainly buying more gold, and that's been a driver. We've also seen some fears of currency debasement driving this, but with the flows into gold and the buying is becoming a bit speculative. Gold is hard to value because it doesn't generate dividends or interest. There are no earnings. We view gold more as an insurance type of play and should never be more than a small percentage in investor portfolios. And it took gold a very long time until recently passing its 1980 inflation adjusted peak. So do keep that in mind. And again, we view it more as an insurance play, but not something that should be a core part of investor portfolios. Let's talk about some other risks in the market, and the concentration is back. The weight of the top 10 stocks in the S&P 500 is almost 40%. That is a record high. Big concentration. If the AI profitability doesn't come to fruition, we're likely to see this reverse. Something to be aware of for investors. And when you buy a passive vehicle, note that there is some big concentration under the hood. So you have to be careful of that. A mix of both passive and active is most prudent in our view. And if you look over time, the equal weight index, which keeps all stocks on equal footing, has outperformed the market weight since 1970. So if you look on the far right, you'll see since inception, the equal weight has outperformed the market cap weighted. And only 2 decades where the market cap beat the equal weight. Of course, in the 2020s, it's been a fairly persistent outperformance, likely due for a correction here or getting back to historical trend. But on a longer term basis, important to note this as we enter a period of very high concentration in the market, we believe it's prudent to not chase that concentration and remain diversified. And of course, the biggest driver and fundamental backdrop for stocks has been the strong earnings picture. We are big believers that earnings drive the stock market and therefore should be closely tracked. Here we show actual versus consensus earnings. And on the lighter blue line, you'll see that earnings growth over the last 3 quarters has been very strong, double digits and easily surpassing the consensus heading into earnings season for the third quarter, which just began. The expectation is for a 9% earnings growth rate that is still very healthy and well clear of the low single digit rate that would be more concerning for an equity investor. So earnings have been a key driver, and those earnings have held up despite tariffs. In fact, earnings expectations have been slowly coming up for the full year, which is a positive for the equity market. And you can see full year expectations for 2025, 11%, with a 14% growth rate for 2026. That's likely too high, but and expected to come down. But again, well clear of some of the weaker growth rates that might be more alarming. So earnings continues to be a very key and important driver of the stock market. We see that continuing. Let's move to the bond market. Municipals still look attractive. Here is the average yields of broad bond indices. The green is the taxable equivalent yield on the muni bond index. You can see it spiked higher earlier in 2025, creating a gap to taxable counterparts, which is really rare, and that was due to a supply-demand imbalance. You'll see the green line coming down. That means municipal bonds are recouping back to their historic average or moving more in line. We still see value given that gap. Some very attractive yields in the municipal market for investors that can benefit from them. And we think this relationship will eventually go back to its historic average. So munis bouncing back, they are still attractive for investors looking to put money to work. Very attractive taxable equivalent yields. Let's move to the Fed and their expected action. The market pricing suggests the Fed is going to lower interest rates another 2 times here in 2025. We agree with that, with another rate cut expected at the late October Fed meeting and another in December. The market's expecting 3 more rate cuts, or almost 3 more rate cuts in 2026, whereas the Fed has come out and said just 1 more rate cut in 2026. Our view is the economy is healthy enough and inflation stubborn enough that it's likely the Fed's view might win out here. We think that 1 rate cut seems more appropriate for 2026, although we do see the Fed moving ahead with 2 more rate cuts for this year. If the market expectation is realized, that would put the overnight rate down around 3 in late 2026. But important to remember, the market has often been wrong. So futures in the past directionally maybe have been correct to where the Fed funds rate actually was. But here we went back in time to show the futures curves relative to the Fed funds rate at that time. You can certainly see in 2022 and 23, the market never thought the Fed would raise rates as high as they did. Even in 2018 and 19, those expectations were off. And again, aggressive rate cut expectations coming in here in 2025. We do think the Fed cuts rates, but those market expectations a little too aggressive in our view. And when we look at the broader bond market, yields have come down. This is a 2 and 10-year Treasury yield. And you can see at the low end of a range going all the way back to 2023. But we believe this range continues to hold. A lot of the good news on Fed rate cuts have been priced in our view. And we see yields bouncing in a range as the Fed ultimately pauses at some point in 2026. We need a recession, in our view, to see yields go below this range. Conversely, to see yields approach the high end of this range or break above it, we would need to see a spike in inflation going forward, which we don't anticipate. So range-bound yields, more of a coupon clipping environment, which we think is okay for bond investors. And then in terms of high yield bonds, we're not seeing value there. The average yield advantage of high yield relative to treasuries is back near a historical low, just under 3%, actually. Not a lot of value there. If you're going to take risk, do so in equities, not high yield bonds. You can see here the recession areas are highlighted in gray and show some spikes in credit spreads, but not getting a lot of value and certainly well below the historic average, which is the blue line on this chart. So we stay high quality in fixed income to be a diversifier in the event of a more adverse environment for the equity market, and finding better value there as well. So with that, I want to say thank you for joining the webinar and our views on the market. Going to pause there and see what questions we have and address those now. All right, so in terms of our questions here, go ahead and move to the first question, which relates to small cap stocks. Does the recent strength continue in small caps relative to large? And our view is obviously we don't know exactly, but we made a move over the summer to reduce small caps, perhaps a little early. The concern with small caps, of course, is that the lower quality stocks are outperforming. We think small caps should be owned more in the early stages of a recovery, not now, which is not coming out of a recovery. While valuations are still attractive, we prefer large cap stocks because of their more defensive characteristics in the event we get an unexpected slowdown in the economy or corporate profits. So no, we are not chasing the small cap rally and maintain a bias towards large cap stocks, which we're recommending for all investors. Moving on to AI, a couple questions on the growth of AI and capital expenditures on AI. First one is data center demand, and from everything that we see, and we're certainly seeing some investments in the private capital space that provide some attractive opportunities. There simply isn't enough data centers to match demand, even from a cloud computing standpoint. So we continue to see that data center build out continuing, no sign of that letting up, and there's simply a big mismatch in terms of demand and supply there. So looking for the data center build out and AI capex to continue. What about AI creating a bubble? That was the other question on AI. That is a risk on the markets, and it's still a question as to whether all of these AI related investments will ultimately be profitable, and to what degree will they be profitable. And that might still take quarters or maybe a year or two, if not longer, to determine that. So that is a risk, but we do as to how that ultimately benefits corporate profits. All right, do we consider this a bull market? Yes, we do. And the other part of that question is, how long does it continue? The bull market just made its 3-year anniversary here in October 2025. That's still relatively short for the average bull market, which goes 5 to 7 years. So more runway, if history is any guide on this bull market. So do remain invested in this market, even with the recent strength. Two questions on how likely are we to see a recession. We don't see a recession on the near-term horizon. That could, of course, change. But when we look at consumer spending habits, corporate profitability, nothing that would suggest that. And more importantly, and this relates to another question, on 2026 and our outlook, there will be a flood of tax refunds in 2026. The One Big Beautiful Bill Act will be very stimulative in 2026 before those impacts fade and become restrictive in later years. But we will see a flood of income tax refunds, very stimulative over the near term. That should provide key support for the consumer, for the economy, and provides a favorable backdrop as we look into 2026. Certainly with the strength of equity market performance, we're believers that over the long term, returns do revert to average, and we see more modest mid to high single digits for the equity market in 2026. Input question on the implications of a weaker dollar and where to invest. I think that the US dollar were to weaken further, and it's certainly possible, not just from a speculative nature, but the fact that the dollar remains elevated on a historical basis. The best way to protect that is to remain diversified, not just with some international equities, but well diversified across all investment asset classes. And then question on cryptocurrency investments. Again, very speculative. I view that similar to gold in fact, in terms of viewing that more as an insurance policy rather than a key part of your portfolio. It does provide protection, but more so for overseas investors who might have more volatile currencies as opposed to the US dollar. All right, that ends our questions for today. Thanks very much for joining our webinar. We'll look to speak to you again very soon. Thank you and have a great day.